Imagine a world where mainstream economists are still scratching their heads over Bitcoin. And ask yourself, should we be surprised? When a heavyweight like Ken Rogoff, renowned for his macroeconomic expertise, publicly admits he underestimated Bitcoin, it's a signal that this digital phenomenon challenges our conventional understanding of money. I've personally learned a lot from Rogoff over the years, from my time as an MIT student to working on projects like Libra, and I've seen how deeply rooted traditional views can be. Yet, even after his acknowledgement, many of his assumptions about Bitcoin remain incomplete. Why? Because Bitcoin isn't just another asset. It's a fundamental architectural shift in how we conceive of money and financial systems. This isn't the first time an innovative idea has faced skepticism. When I first explored cryptocurrencies during my early academic days, I was warned that I risked career ruin, dismissed as chasing a Ponzi scheme. But as Rebecca Henderson's pioneering research shows, true disruptors aren't obvious at first. What truly challenges the system are subtle, structural transformations that are hard for traditional minds to see until they become undeniably clear. Bitcoin is just one example of such an architecture in financial design, a different way to think about money itself. Many economists react instinctively because Bitcoin conflicts with the very principles they've been taught. The idea that monetary policy is an effective tool, and the notion that central banks are truly independent and consistent. But if you look at Bitcoin as a neutral asset, akin to digital cash, and a foundational financial infrastructure, the pattern suddenly becomes clearer. It's a new form of money that operates on open-source protocols, which means it exists beyond the control of any government or institution. And here's where it gets controversial. Bitcoin's real breakthrough is that it addresses a long-standing problem in digital currencies, double spending. Before Bitcoin, digital money always required some central authority to verify transactions, such as a bank or a wallet provider, making it inherently centralized. Satoshi Nakamoto made a groundbreaking leap by solving this problem through cryptography and incentive mechanisms, creating a scarce, trustless, and censorship-resistant form of digital money. Unlike gold, which has been a store of value for centuries, Bitcoin's properties are different enough to redefine what we consider a category of its own: digital, limited, and user-controlled. While gold has physical utility and historical longevity, Bitcoin's digital nature offers unique advantages as the world increasingly moves online. Its ability to be spent, stored, and transferred electronically without the need for intermediaries gives it immense potential as a societal level financial infrastructure. Think of Bitcoin's network as an open, neutral settlement layer that can scale to meet real-world payment demands, transforming how value moves across borders and borders. What is the societal value of a truly neutral digital currency? Now, let's talk about price. Because media and the crypto community often obsess over its wild swings. Yet if you look at Bitcoin's price on a logarithmic scale, a more stable, upward trajectory emerges, one that aligns with the diffusion of innovation model introduced by Everett Rogers. It began within a tight-knit circle of cypherpunks and developers, then gained early adoption among risk-taking investors and countries dealing with unstable currencies, often seeing Bitcoin as a safer store of value or a means of payment in troubled economies. Today, it's embraced by mainstream financial institutions and even sovereign nations, eager to integrate it into their strategies. This gradual adoption fits the classic S-curve pattern: early growth, rapid expansion, and a potential plateau or exponential leap once it reaches mass adoption. Since Bitcoin has a fixed supply of just 21 million coins, this process naturally leads to slow, steady appreciation over time, moderated by regulatory and market swings. Whether Bitcoin finds an equilibrium price, if it remains niche or becomes fully mainstream, depends largely on where we are in that adoption curve. As an investor, it's worth considering the comparison to gold, payment networks, and potential technological innovations that could either propel Bitcoin forward or hinder its growth. Underlying all of this, Bitcoin exemplifies the evolution of money itself, from a physical commodity to a form of software. Throughout history, our idea of money has shifted from shells and beads to metals, then paper notes, and now digital entries in databases secured by the best cryptography. This oscillation reflects our ongoing balancing act between harder money that preserves value and more flexible forms that support liquidity, an ongoing pendulum swing between creditors and debtors. Considering this history, it's not unreasonable to think that a stable, cryptographically secured, neutral form of money could be the next big step in global finance. Like previous monetary evolutions, Bitcoin's value depends on collective belief. The more people trust and accept it, the stronger its trajectory. That's why some powerful companies and institutions are acquiring Bitcoin, hoping it will become the ultimate safe haven, even leveraging risky strategies to maximize their holdings. But here's the twist. If society's confidence in Bitcoin falters, perhaps triggered by reckless leverage, sudden market corrections, or other shocks, its price could plummet to near zero. We've seen similar dynamics happen in traditional fiat currencies when trust in governments erodes. Bitcoin itself isn't debased or colluded with decisions like central banks, but its value hinges entirely on social consensus. Paradoxically, aggressive, leveraged buying by some of these large treasury-holding companies might threaten to undermine confidence, highlighting that beneath its revolutionary veneer, Bitcoin's fate is still intertwined with human psychology and collective trust. And this is the part most people miss. Even if Bitcoin's technology endures, its real societal value as neutral infrastructure, disintermediating traditional finance, reducing costs, and creating economic opportunities, remains. Would you agree that Bitcoin's transformation is less about the price and more about how it could reshape economic systems? Or do you see a different future for this digital innovation? Drop your thoughts below.